Interest rates are rising in the UK again. But what does this obscure number, decided by a group of economists, actually mean for you? Here's a clue. There's much more to it than just rising mortgage payments. This is what the Governor of the Bank of England had to say on the 3rd of November.
We've increased bank rate by 0.75 percentage points to 3%.
To put this into context, this was the biggest single interest rate rise since the fall of the Berlin Wall and will have a huge impact on the entire British economy. So why are they rising? We've had years of low rates and cheap borrowing. First things first, one of the main issues here is inflation. But what the hell is that? To understand what interest rates do, it's first important to understand inflation.
So most of us will find that the cost of products when we go to the supermarket, the cost of our energy bills, the cost of our housing is all increased, and that's due to these inflationary pressures.
Let's dig a little deeper. Inflation is hitting household budgets across the board, but families' food budgets are being hit particularly hard. Journalist Katie Grant has analysed the price of the humble tomato. What does this staple food, beloved by so many around the world, tell us about inflation?
When we're looking at inflation, it can be quite useful to look at something very specific that we all probably have in our fridges, whereas previously they actually went up just sort of incrementally in price each year. In the 12 months to September 2022, the price of a kilogram of tomatoes went up by 22%. Tomatoes are a really energy intensive product to grow. They're grown in greenhouses. We all know with our energy bills at home, prices are going up. Wages have gone up. There are labour shortages in the UK and growers need to be more competitive in terms of what they're paying their staff. And then finally, the transportation of getting that to wholesalers and into supermarkets is going up because, as we know, fuel prices are very high at the moment.
So when the price of food rises, along with so many other products we need to survive, whose responsibility is it to try and shield us from these rising costs? Enter one of our main players, the Bank of England. The Bank of England is our central bank here in the UK. It has an important role in keeping inflation at just 2%, enough for the economy to grow, but still low enough that your household finances don't take a huge hit. So how do they maintain financial stability? That's where interest rates come in. The bank sets what's called the bank rate, probably one of the most important numbers in the British economy. The bank rate affects how high street banks price borrowing and rewards for savings, having a direct impact on what you or I pay for our mortgages and loans. This is the lever that the bank will pull to affect inflation. The bank's Monetary Policy Committee, made up of 9 members, led by the bank's governor Andrew Bailey, reviews the bank rate around every 6 weeks, and they've been steadily increasing the rate recently. It's something we haven't seen for quite some time. Higher interest rates make borrowing more expensive and saving more lucrative. The theory goes that this will encourage people to spend less, lowering demand for goods and services, eventually pulling down inflation. You essentially reduce the supply of credit to the whole economy in one fell swoop.
So when people save, as they're incentivized to do through higher interest rates, the less money they have in their pockets to spend in shops, on goods and services across the economy, that decreases the rate at which prices rise. And that's what the Bank of England's intention is through increasing interest rates at the moment. It affects businesses' ability to borrow, to grow their businesses and invest in the economy. It affects homeowners' ability to keep the roof over their head, and also diminishes their ability to spend money on other areas of the economy and invest in their own local economies by buying goods and services locally because their household budgets have been squeezed. Same goes for private renters.
Okay, so the Bank of England are entirely responsible for the squeeze on people who have a mortgage or rent their home from someone who does. Hold up, not so simple. While they do decide the bank rate, which has an impact on the interest rates we have access to, there are other players in this, and there are many factors outside their control. Remember that 2% target of inflation the bank is trying to maintain? That is set by the government, and indeed, most countries around the world aim for 2% as it's seen as a healthy balance for a stable economy. But keeping to 2% is a tricky task, and the Bank of England aren't in control of all the factors. Globally, Putin's war in Ukraine has had a big impact. Russia is a key supplier of oil and gas, and Ukraine is a key transit route for much of that oil and gas to European markets, so the price for oil and gas have gone up. Markets have reacted to this uncertainty by adding a risk premium, so prices go up even more. That puts up our household bills and the prices of many products such as tomatoes, driving inflation. This is clearly not something the Bank of England could do something about. But then there are domestic issues the Bank of England does have a role in. Liz Truss's mini budget promised a major round of tax cuts which would have put more money in people's pockets. But that would have encouraged them to spend, just as the Bank of England was trying to slow down people's spending to curb inflation. In the market turmoil that followed the mini budget, the bank helped stabilise the economy. It rushed to buy government debt to bring stability to the markets, while also giving a statement on its plans to tackle inflation by, you guessed it, raising interest rates. Truss's plans have now been canned by his successor Rishi Sunak, but the interest rate increases issued in the wake of the mini-budget remain. And with inflation running at around 10%, this could mean even more rate hikes are on the horizon.
If inflation increases, we can certainly expect to see further increases in interest rates. But irrespective of that, almost all forecasts at the moment point to much higher interest rates over the next 12 months or so. This would have been happening anyway in all likelihood, but the rate of those increases has been sped up quite significantly by last month's disastrous fiscal statement. So I think households and people across the country can really expect to see interest rates rise, and at least for the time being, inflation to also be very, very high.
Raising interest rates is a tricky balancing act, and often the Bank of England is looking into the future to see what will be needed rather than responding directly to events on the day. If the Bank of England raises interest rates too quickly, it's like slamming the brakes on the economy. This could tip us backwards into a recession. However, if rates are raised too slowly, inflation could pick up momentum and remain high for longer and become harder to halt, with the cost of goods becoming more unhinged from people's earnings. Still, there's no denying interest rates can be a blunt instrument to keep inflation low. Those with large debts, such as mortgages or loans, will feel the impact acutely, while those with cash to spare will benefit from higher interest rates on their savings. This could increase wealth inequality in the UK. People like you are waking up to the fact that borrowing is not going to be cheap forever. Interest rates are rising in almost every major economy, from Norway to South Korea. But if it's one thing history shows us, is that periods of high inflation cause major political instability. We're in for quite the ride.